The inflation numbers for January were just released on Tuesday, February 14th, and it looks like, at least for now, I was wrong. Not only is inflation staying elevated for the month of January, but it actually climbed more than it has in the last 3 months. I have been saying for quite a few months now that I think during Q1 of this year, 2023, it's very possible we see inflation year over year come below the Fed's target of 2%. And by the end of the year, we could very easily see deflation year over year. If you take a look at this chart from Bloomberg, you can see what has happened the last couple of months. You can see that in January, the price change from December to January, from one month to the next, was up 0.5%. We also saw an increase in year-over-year inflation hitting 6.41%. A few definitions we need to get out of the way just so that we're all on the same page. Inflation and deflation, I'm using modern vernacular. I'm not going to mess with semantics about what those words meant 100 years ago. I'm talking about the official narrative, the CPI. Even if real numbers are different than that, the Fed makes its decisions off of these numbers. So if we want to anticipate where the markets and the economy might go, that's driven by monetary and fiscal policy, and they're making those decisions based off of these numbers. So that's what I'm looking at. I don't care if my eggs actually went up 10 times and they say it only went up 8.5%. Obviously that makes an impact on my budget, but when I'm looking at where the economy is going, I'm going to be looking at the official numbers even if I know they're wrong. Number two, we have to distinguish between inflation, deflation, and disinflation. Everybody knows inflation. That means prices continue to go up. It's like a car that is moving forward. We also have deflation. That is prices that are moving downwards. The price level, the actual price is dropping. That's like a car in reverse. If you have a car that's not moving, it's just stopped, that means that's like price is not changing. No inflation, no deflation, no disinflation, just 0% across the board. Disinflation is when prices are still going up, but the rate at which they're going up is slowing. So if it goes up by $10 this month and then $8 next month and then $6 next month, that price is still moving up. It's like the car is still moving forward, but it's decelerating. It's going from 50 miles an hour to 40 miles an hour to 30 miles an hour. And so when you see disinflation, that's a sign that you might see deflation in the future if that trend continues. If the car is slowing down, eventually you'd expect that car to stop and maybe even starts to go in reverse. One thing I need to point out about this chart, look at the month of December here. Month of December is showing a positive month-over-month number. Do you remember 1 month ago, when the numbers came out for December, it was showing month over month deflation. And I made a video about this and I explained, look, from month of November to month of December, prices actually fell. Well, shocker, they went back and looked at the data again once there was more data available and revised it upwards. There was no deflation month over month in December. So once again, these bars on the top of the chart show what prices did from 1 month to the next. From December to January, prices rose 0.52%, and that is more than they've risen in 1 month all the way since back here. This chart down here is year over year, so it's comparing January prices of 2023 to January prices of 2022. Now, obviously, sometimes you're going to see charts like this that highlight less food and energy. That is the core CPI. That means we're going to look at the inflation, the average price level of all these items, but we're going to remove the stuff that people have to continue to buy no matter what, because those are going to show up more of the inflation because people have to keep on buying those things. And that's exactly what we're seeing now with rising shelter costs accounting for about half of the monthly increase. Now, this is not going to be primarily driven by home purchases, home buyers. The rising shelter costs that are showing up right now are being driven from the surveys they do for owner-occupied rent, or owner's equivalent rent and rent of primary residence. Now, this data is very lagging. It takes a long time to show up in the official numbers, but for anybody who is looking for a complete collapse in the housing market, you'd want to see rent prices being way lower because there would be an incentive then for people to lose their houses that they've bought because they can just save money by doing so. That's what led everybody to walk away from their homes in the financial crisis because it was like, I can't afford my new mortgage right now. The prices just adjusted upwards. I'm just gonna, stay in it until I get kicked out, and then I'm gonna go rent for a lot cheaper. It's not the case right now. Anybody who gets kicked out of their house is gonna be paying a lot more for renting or for buying a new place at these higher prices and higher mortgage rates. So we can see here that the average annual inflation rate is still high at 6.4%. Major categories driving that are going to be food at 10.1% and energy at 8.7%. So obviously these inflation numbers are much higher than I expected. I expected these inflation numbers to start coming in lower, given what drives a broad level of price increases or decreases. That is the money supply. If we look at the money supply, we can see that year over year it has declined. In fact, the pace at which the money supply growth is declining and reaching negative territory has never happened before in the history of the data. So we are witnessing a very quick reduction in the supply of money available, and the only thing that can happen when that happens, paired with a very high amount of credit usage. Everybody's loaded up on credit card debt, auto loan debt, household debt, corporations debt, government's debt. When you pair those things together, and then you throw in the curveball of rising interest rates to try and deal with that inflation, you do have all of the ingredients you need for a very quick price collapse. That's why I don't think it's possible that we see a soft landing. I think the Fed is intentionally looking at data that supports them continuing to fight inflation harder and longer than everybody else wants them to. And so it's probably going to take longer than I expect it to. I usually expect these things to happen much sooner than they really do. I mean, just look at what happened in the financial crisis. So many people knew what was happening with the housing market, and it took years for it to unfold. These things take longer to unfold than it seems like they should once you know what's going on behind the scenes. But at least for now, I'm either wrong or just early. And I'm still recording this about halfway through the markets being open today. They did open up higher, but now they have started to sell off as the market starts to anticipate the reaction by the Fed, which will probably be tightening even more as yields are skyrocketing now and raising interest rates, selling assets off their balance sheet, because all this data means, paired with the jobs numbers that they are looking at, which again, I don't think are real, but it's what they're looking at, is going to support more and more tightening, which I think they'll over tighten and cause a big economic collapse. As always, really appreciate you guys. Thanks so much for watching. Have a great day.